Is inflation good for silver and gold? Actually, yes, and other tangible assets as well. We're going to talk about the last few years of red-hot inflation has done to silver and why gold also benefits, but for different reasons. We'll wrap it up with a bonus about how inflation has affected another asset class you may be interested in. Stay tuned. Before we begin, please take a moment to like and subscribe to support the channel. Thank you. Inflation is in our lives and we're all feeling the pinch. Whether it's buying groceries, paying for housing, or just living the general day-to-day life, we've all felt it in one manner or another. Inflation does have an interesting knock-on effect for those of us invested in hard assets, though. And when I say hard assets, I'm talking about real estate, silver, gold, and other tangible assets, things you can touch. Inflation tends to improve the price of tangible assets to a large degree. With the Fed raising rates, there's been some downward pressure on hard assets, but it's a temporary pause rather than a reversal. Let's talk about why. The first thing you should know is that inflation affects gold and silver differently. Inflation is raising the ceiling for gold and it's raising the floor for silver. We'll start with silver. Silver is absurdly cheap given its wide industrial use. Each ounce of silver that comes out of the ground does have a cost associated with it. And with inflation, those costs have risen. The mining equipment, maintenance, wages, services like accounting and legal fees, they've all gone up. I know we all feel that silver is expensive when we see a 20% premium, but remember that for every ounce of silver coming out of the ground, the premium is only a few bucks. And those few dollars pay for the mines, mints, retailers to all stay in business. Now, if the spot price drops too low, the mines will simply stop selling their silver until the spot price rises again. This has happened before, and we would expect it to happen again. There's no way any mine will sell silver if it drops to a point where they're operating at a loss. And now the threshold for that is much higher thanks to inflation. In the early 2000s, silver was about $5 an ounce, but the mines would go out of business if they tried to sell at those prices today. Different mines have different financials, but if the price of silver drops too low for too long and the mine can't hold out on selling at a loss, they'll close. Supply will restrict and price will go up. So inflation in a very real sense has raised the floor on silver mining. Now, gold mining is a little bit different. They're affected by inflation as well, but their financials are just not the same, and the use case for gold is different from silver as well. Now, silver is primarily an industrial metal when considering its consumption by use case. Over half goes into producing things. Gold is primarily a financial instrument or currency and is a safe haven asset. Over time, what we've seen with gold is that its value increases alongside the increase in the monetary supply. This is why an ounce of gold could get you a nice suit in 1950, and it can get you a nice suit today. But an ounce of gold was about $40 in 1950, while it's pricing around $2,000 an ounce today. In 1950, you could get a men's suit for $40. If you tried to buy a suit for $40 today, you'd be laughed out of the store. You can't even get a decent belt for $40 anymore. So when inflation comes home to roost, it generally is good for gold in the long run, but it's a combination of inflation and low interest rates that gives gold the biggest bang for its buck. When interest rates are higher than other safe haven assets like treasury bills are preferred to invest in instead of gold because their yield goes up. And when the rates drop, as we're expecting to see later this year, then we would expect the yield on treasuries to decline and the price of gold to increase again. This is why most major banks are calling for gold to hit new all-time highs in 2024 or 2025. And this is why we say that inflation raises the floor on silver and the ceiling on gold. Silver won't necessarily follow gold at the same rate that gold increases because it has a different use case. But in either situation, both metals have a purpose in an inflationary environment. Now, one bonus tip, because it's probably worthwhile mentioning, that tangible assets in general tend to do better during inflationary periods. Home values skyrocketed after 2020. People were able to sell their cars at a profit for a couple of years. Pretty unusual. And the value of collectibles also increased. Now, the collectibles market has a compounded annual growth rate of 6.2%. This includes books, watches, sport memorabilia, stamps, and also rare coins. We've had some incredible numbers come in that show vintage gold coins outperforming bullion over the last 5 years. And this is likely due to the inflationary effects bolstering gold combined with the scarcity that vintage gold has. As items become more scarce and money more freely available, it has the potential to create a cocktail of sharply increasing prices in commodities and luxury goods like collectibles. Now, we're going to do another video on this because it's really fascinating how the value of vintage gold has grown over the past few years. Now, just as a little preview, our cost for some of the vintage pre-33 gold like this has increased by an additional 2,000 basis points over gold American Eagles during the last 5 years. If you are interested in collectible coins, you might look closer at vintage gold like pre-33 gold coins, or vintage silver like Morgan silver dollars or peace dollars. These are no longer in production, and so scarcity is playing a role in increasing their value. There is a concept in coin collecting called surviving mintages, and it reflects the fact that every year more of these coins are lost and the circulation is reduced. It's a little bit different from something like a graded gold buffalo. Last year's graded gold buffaloes have a limited mintage as well, but they're still making buffaloes, so it's a little different. And lastly, we should mention the inflation outlook does not appear too promising. Sure, the Fed has tightened on us considerably by raising rates rapidly, but deflation is different from disinflation, and they're not interested in lowering prices. They're interested in lowering inflation to 2%. And so far, they've been unsuccessful getting CPI below 3%. So inflation is here to stay, and it's likely going to just be harder to get inflation down when the multi-trillion-dollar Build Back Better Act is sending a tsunami of money into the economy. So even after the Fed declares victory and ends their tightening campaign, we still expect to see inflation well into the future, which should fuel further price increases in tangible assets. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.